Everyone, it's Matt Williams for JTM Williams Capital Management. This is a review for June 2026, as well as a mid-year mid-year review. That's right, we're halfway through the year already. I'm recording this video on Sunday, July the 5th, 2026. Hope everyone is having a fantastic 4th of July weekend, celebrating the 250th. As a reminder, the ETFs, indexes, and securities mentioned in this video are for illustrative purposes only and do not constitute a recommendation to buy and sell. Please refer to the disclosures at the beginning and end of this video. Please make sure to like and subscribe the video and the channel. Let's get started. I'll go ahead and share my screen here real quick and we will. All right, here we go. All right, so we're going to start off with just a general rundown of just how stocks, bonds did here, the first half of the year. So again, bear in mind, we're looking at data here as of July the 2nd because of when I'm recording this video. So the first 2 days of the third quarter are going to be included in this. But here for the mid-year, we're about the S&P's up around nine and a third. The the aggregate bond index total return is up 0.7%. Yields are up for the year. We'll get to that a bit here with the bonds. Um, here with the S&P, not a whole lot has changed here. We've really kind of broken into what you could either say is a diamond pattern or a falling flag. Uh, either of these, one would think, at least in terms of these being consolidation patterns or continuation patterns, will end up resolving in the direction of the underlying trend. But we'll have to see. Obviously, this can be end up being a reversal pattern. We end up heading lower and end up testing this breakout there that occurred in mid-April. But obviously, we have to end up seeing what happens. Go on to the Nasdaq. Same thing. Looks fairly similar. The Nasdaq obviously is what, and tech stocks in general have been what's let us off the low here. At the end of March. We'll move on here, start going sector to sector. So obviously technology is the largest sector. I will end up showing semiconductors here because at this point they are more than half of the tech sector and more than 20% of the S&P. And at this point, if they were their own standalone sector, semiconductors would be the largest sector in the S&P now. So again, tech has been consolidating here. We've had some weakness the first 2 days of the quarter. But here, at least for the half year, they've by far been the strongest part of the market. Let's take a look at the stocks. Same thing. That has just been an absolute, ripper here off of the March low. We'll go and let's start going down. Now here you're going to end up seeing again a refrain here that there are things to be concerned about here under the surface. Even though I'll say most of what I'm going to be showing you, I think on balance is constructive or bullish. But there are some things. Let me actually back this up a little bit so we get more of a big picture. So. Um, Communications, this is Google, Meta, etc. Not necessarily looking that great, especially have shown a lot of relative weakness here in the second quarter, first half of the year. Discretionary, really same thing. Does not is mostly just been consolidating here. Again, another big relative weakness. Now, here recently, what has happened is if you have had funds, or let me say this, that you've had the beginning and then potential reverse of this, where the Mag 7, I think we covered in the last video the historic spread between the Nasdaq and the Russell 1000 growth, and a lot of that's had to do with where certain semiconductor stocks have found themselves, whether or not they're in the growth, the value index, and again with this, what I'm going to end up showing is. You know, The Mag 7, and I think a lot of large cap tech, in some cases, have been a source of funds for semiconductors. You've had rotation from like NVIDIA, Broadcom, and I think most of the Mag 7 into the rest of the semiconductor index. Now, when that works in reverse, because it's such a large part of the S&P, um, there's only a couple places in the market that are deep and liquid enough to absorb that type of flow of funds. It's other Mag 7 stocks, it's financials, it's healthcare, it's going to be part of consumer discretionary. There are just only so many liquid parts of the market that can actually take that much if you just start having, a few percentage points come out of semiconductors, let's say what's happened here the first two days of the quarter. So again, let's look at the mags. Notice how you see here semiconductors start selling off as these have led. Now let's start looking to get back at Mag 7. even though the Mag 7, yes, did rally off of this, it's still been in a fairly decent relative downtrend here since Halloween of last year. And again, as semiconductors have sold off, you have seen money rotate back into some of the big stocks. Let's just take a look at Apple, Meta, Google, Nvidia. I know Broadcom's not in there, Tesla, Microsoft. So again, so you have had some rotation back into that. Let's look at some of the other big sectors again. Financials, right there. I think if I had to imagine some of the money coming out of semiconductors are finding their way into financials. Same thing with healthcare. Now, this has just been an absolute ripper here in the last 2 weeks. Again, I think this is another part of the market that as money has come out of semiconductors and some of the tech stocks, you're seeing rotation, not necessarily money leave uh, the market. So again, if we look at S&P equal weight, while this was a very large laggard, off the March bottom here until around mid-May, it's making a new high. So again, what that's telling me is this is rotation right now. This is money leaving certain parts of the market that have done real well and are getting rotated again to certain liquid parts of the market. Is part of, again, let's just say this could be beginning of Q3, end of Q2, beginning of Q3 rebalancing. All right, let's keep moving on. Obviously we just looked at tech. Let's keep looking at some of the other sectors. Industrials, again, have been doing well. Again, let me just slow longer term. Industrials, we'll look at consumer staples, utilities, we'll look at REITs. Those are trying to break out. You've had a lot of start and stops here the last few months. Materials, take a look at metals and mining. That's actually had quite a fake out here, beginning of June. Energy stocks, they're trying to find footing here. What we'll get to here in a bit, obviously, is when I start reviewing commodities here near the end. What we're going to look at is there is a very large divergence between gasoline and WTI and Brent. We're going to go over what crack spreads are here near the end of the video. But energy stocks, again, as at least the market's interpreting what's going on in the Middle East as starting to cool down. There have been some ships that started moving through the Strait of Hormuz. Oil has come down here in the last month, obviously with the signing of the memorandum of understanding. I'm not going to get into the politics of it. Um, let's keep moving on. Right here, let's just take a look at sectors again. Technology still a leader, healthcare, consumer discretionary, comms, financials. So again, I think as some money has come out of tech, it's finding its way in healthcare, it's finding its way in financials. REITs, industrials, consumer staples. Again, we just went over energy, materials. I mean, again, I think what this is telling you again is if there's parts of the market, obviously there is dimming strength, still tech, semiconductors, uh, financials, healthcare, industrials. So again, those are fairly bullish parts of the market. You're not seeing a defensives lead this yet. Let's get to the next part here of the market. We'll look at factors. It's still S&P 500 growth, still is hanging in there. Now, again, I'm not going to get into we went over this in the last video. Your definition of growth and value at this point is different because again, I can show this right here where you look at what the Nasdaq's doing relative to the S&P, and it's holding up much better on a relative basis than, excuse me, this is the S&P, but the Nasdaq's holding up on a much better relative basis than what growth is itself. Value's trying to carve out a bottom. Low vol's trying to carve out a bottom. Equal weight's been picking up here, after some really, really bad or negative breadth most of the beginning of Q2. Uh, momentum. Now here we're going to get to something here about momentum. Most of the momentum index right now can be effectively construed as the AI trade. Most of what is in the momentum index at this point is semiconductors, which is tech. The industrials in there, Caterpillar, GE, GE or Vernova, are involved in the AI data center build out. So again, what I'm going to show here next, give me 1 second. Um, if you go to, okay, what this is, let me back up here. Okay, what this is a seasonality chart of the MSCI momentum index. And what this is going to show here is we're getting into July. The last 5 years, momentum as a factor has done horrible relative to the S&P. Seasonally, this is by far the worst month for the momentum factor. Now, for those that don't know what momentum factor is, there's different ways you can measure it. There's several ETFs or several indexes, but for lack of a better term, it's you're buying the leaders. You're buying the stocks in the S&P 500 via rate of change, relative strength, whichever measurement they do, where you're basically buying either technical or performance leaders and you're holding them. I'm not going to get into the back testing or any of the history behind it, but it is one of the important factors. I happen to, be a trend trader, relative strength trader. But again, in July, if I had to imagine why this is showing, why you have not had a single July here so far this decade where momentum has outperformed the S&P and it's got a negative spread relative to it, is again, I would just say that the second half of the year starts, Q3 starts, and you probably get a lot of rebalancing. So you end up having a lot of portfolio managers that start selling down a lot of their winners to reallocate, rebalance their portfolios. And that's most likely what I think causes a seasonal weakness. Is already, again, happening here so far. If you're here for the month of July, we keep moving on. As far as let's get into risk appetites. This is why I'm saying I think what you're seeing right now is more of a rotation and not necessarily money leaving the market. Where, again, the Nasdaq, again, still leading the S&P on a relative basis. If there are two places to be slightly concerned, you still haven't seen consumer discretionary on either a cap weighted or equal weight basis really confirm the new highs. Uh, um, that's again, I'd say flashing yellow light. Uh, because again, I think if you look at something that typically has a fairly high correlation in those ratios, high beta to low vol is still from bottom left to top right. I think, as I mentioned in the previous video, there is an ETF that is the inverse of this, that it's a spread trade or pair trade, where if you do think eventually that this whole semiconductor AI momentum unwind is going to occur and you're going to have a big rotation from the high flyers into the defensives, there is a ETF that I covered in a previous video that I do think would be a good way to play that. I'm not going to get into this one. And then credit spreads. Again, high yield bonds relative to treasuries are still outperforming, going from bottom left to top right. Again, that's one of the big things I look at is credit. As long as junk bonds, which are your riskier parts of the bond market, continue to outperform the lower risk or less risky treasuries. Again, I think that's a signal to be constructive on the market. Moving forward. Now, getting on to international markets. International markets here year to date. This is going to be, kind of a mixed bag. Most of what has powered international markets here year to date has been the AI trade. The beneficiaries of that have been South Korea, Taiwan, um, China, lots of other parts of, let's say, Europe, India. It's been a very narrow trade, I believe, right now, at least in terms of the emerging market index. Taiwan Semiconductor, SK Hynix, and Samsung, right now, I believe, are almost 1/3 of the emerging market index because their play on AI and the memory shortage. So again, from that standpoint, I'd say be careful internationally and know what you own because a lot of it is now uh, if it is now in a handful of AI stocks in again South Korea and Taiwan. Okay, let's move into the bonds. Um, as I've mentioned many times this year in videos, I think the most important chart in the market right now is the 2-year yield because that's going to influence, or that's the market right now saying where it thinks Fed policy should be. I don't follow the Fed. I follow the bond market. The bond market is smarter. The Fed is going to follow what the 2-year yield ends up doing. So here at the beginning of the year, everyone was saying, "Oh no, we're going to get more Fed cuts, this, that, and the other." And here around February, March, I said, "Hey, look at the ones, look at the twos." I think either we're going to get no more rate cuts, or if this ratio, or excuse me, if this chart starts breaking out to the upside, you're going to start seeing rate hikes. Well, how's the narrative changed here in the last couple of weeks? Now the market is effectively thinking that we're going to get two rate hikes. So, like I said, don't follow the Fed, follow the bonds. If this keeps going from bottom left to top right, there's a very good possibility that the next move from the Fed isn't going to be a cut. It's going to be a hike. Let me look at the 10s here real quick. Here's a 10-year yield. Uh, again, last couple of years really have gone nowhere. It's up, the yields are up here year to date, going from approximately 4.2% up to about 4.5%. We'll see what happens here. This to me does kind of look like a falling flag and has a potential for another move to the upside in yields. We'll happen to see a lot of it's just going to be impacted by what ends up happening in the Middle East with crude oil prices. Let's start getting into commodities, and this will be the last thing we end up going over. Here's gold. Gold again had an absolute blow off top at the beginning of the year, has been having a series of lower highs and lower lows. I think one of the more disappointing things about gold was when the conflict in the Middle East and Iran occurred. I think that to most people would have been the absolute, best case. Oh, we're bombing Iran. Gold should be skyrocketing, and the exact opposite happened. I happen to think that when that occurred, it just happened to be there were some central banks in the Middle East that I think had to start selling a lot of their gold reserves to get liquid because of just some of the things going on there. Just a theory, but again, I think right now it's lower highs, lower lows. If somehow I'd say, this is we're looking at ETF IU, but if it can get back over this level, I do think it could make some room back up to the upside. We'll look at silver. Silver, same thing as gold, but obviously even more of a pronounced move up and then down. Just an absolute blow off here. Uh, again, I'd say until it can get back above this 60 level on SLV and start moving to the upside, I'd say at best, either avoid it or hold on to what you have. Now, again, outside of yields, uh, crude oil, I do think, is sending an important signal. That you had the MOU here signed around here. Trump went and met with Xi in China around here, and it's been almost a one-way street. Now, this ETF, this is not crude oil itself. This is the ETF I typically look at to track. If you look at Brent, it's basically back to where it was before the conflict started. What there's been a lot of chatter about, and this is going to be the last thing I show here before we wrap up here for the video. Um, Gasoline has not come down as much as oil has come down in terms of people thinking, okay, well, oil's back down where it was at prior to the conflict in Iran. Why isn't gasoline price coming down? Well, there's a thing called a crack spread, and what that means is effectively the cost of how much it takes to refine oil into either gasoline, heating oil, or diesel oil. So again, none of us actually consume oil. We consume the byproduct of oil. When we're filling up our cars, our trucks, we are not filling up with oil. We're filling up with gasoline. You take oil, you refine it into gasoline. So here's a chart I'm going to show. This isn't the crack spread per se, but this is the ratio of gasoline to Brent. This is going back 20 years. So again, what I think you should be pretty apparent here is at least the spot of gasoline, the spot of Brent crude, it has never been higher. You go back again all the way here, 20 years, back all the way to 2005 when this data started. You've never had gasoline, this, excuse me, spot gasoline, this highly valued relative to Brent. There are all kinds of theories right now on what's going on. We have destroyed refining capacity. The price of Brent at the refineries is actually higher than what the spot price is. Again, I'm not going to get into some of the conspiracy theories on why this is, but again, uh, I am eventually going to end up having a discussion with one of my friends who's an economist here soon, and this is going to be a big question I ask him because, to the best of my knowledge, oil isn't in CPI, gasoline is. So if we end up having an issue where even though the world could potentially be flush with WTI and Brent, if we can't refine that and gasoline continues to go higher, then CPI is going to continue to go higher, which is why I keep an eye on the 2-year yield because that's going to end up dictating or impacting what the Fed ends up doing. So, uh, you know, that's the, that's the video here. Uh, let's see what the month of July has in store for us and what the rest of the year does. As far as I'm concerned, it's halftime. It's 0-0, so all of us start over here again, and we'll see what we can make a Q3 in the back half of the year. Please like and subscribe this video, and hope everyone again had a very good 4th of July weekend. Please, again, feel free to like, subscribe, contact me, Matt at jtmwilliams.com, 703-782-3110. Look forward to hearing from you. Thank you.